Okay, people, here we are. Our very first chapter has just the bare basics of accounting concepts. Main concept that we're going to be talking about is the accounting equation. So that's your friend. You want to keep the accounting equation in mind as we go through all of these chapters, really. Accounting equation, assets are equal to liabilities plus owner's equity. And we'll talk a little bit about why that is a true statement. Assets equal liabilities plus equity, or the owner's investment in the business. Here we have what we're going to be talking about, our learning objectives. We're going to talk about generally accepted accounting principles. These are the rules of accounting, basic rules of accounting. And we're going to, again, talk about and interpret the accounting equation, each of its pieces or components. We're going to look at some business transactions using the accounting equation, and then we're going to talk about those basic financial statements and explain how they fit together. Right off the bat, generally accepted accounting principles. Sometimes you hear that as GAAP, generally accepted accounting principles. That's the acronym for those principles. This is kind of a nice schematic. Our accounting is governed by rules and concepts, talks about GAAP there. Why do we bother with it? Well, we need to give our accounting information relevance for our users, and GAAP is one way in order to do that. And also, it gives a faithful representation. Tells us that the information in our accounting records really reflects our business results. So it has to do with credibility. Principles, assumptions, and constraints. Okay, general principles gives a definition right down here. Assumptions, concepts, guidelines, specific principles, those would relate to particular business transactions or maybe an event. Sorry, didn't mean for that to come up. Principles, assumptions, and constraint. Okay, there it talks about general principles and specific principles. Kind of a nice little picture there. Now here are four very important rules or principles. First one on the left-hand side there, the measurement principle, counting information based on actual cost. In other words, when you buy something, you record it at what you actually paid for it. At that moment in time, that's its value. A year from now, it may be worth more or less, but we don't go on the assumption, we go on actual cost, actual objective information. And then on the right-hand side, revenue recognition principles. Revenue is just another name for sales. So at what point do we recognize revenue, or when do we recognize that that sale actually happened? And that's when whatever it is we're selling, goods or services, actually get into the customer's hand at an amount expected to be received from the customer. Okay, so revenue recognition. When our customer actually gets their goods and we record it at the actual cost. And then On the bottom left there, expense recognition. You know what an expense is. Record expense incurred to generate the revenue reported. Okay, it's kind of like a matching principle. You match the expense with the revenue, and then on the right hand side is just another statement, restatement of that expense recognition principle. A company records its expenses incurred to generate the revenue reported. We're matching the revenue with the expense incurred to generate that revenue. Accounting assumptions. Well, we make some assumptions. We make the assumption that we're going to be in business tomorrow. That's the going concern assumption. The monetary unit assumption on the right-hand side there. We're going to record that event or transaction in money terms, in dollars and cents, here in the US. Time period assumption there on the bottom left. We can divide our life, the life of the company, into time periods. So in other words, we could divide the information into months or quarters or years. And then business entity assumption, we have to be very careful with this one. We have to account for business transactions separately from other business entities, and in particular, the personal business of the owner. So in other words, say it a little differently, we have to keep the owner's personal business affairs and expenses separate from business affairs and expenses. Here are some forms of organization. Not going to say a whole lot about that. Sole proprietor, most common, partnerships, corporations, LLCs, limited liability companies. All of these have particular qualities, characteristics, and that's a nice slide there. You might want to go to your textbook and get a better look at that. Here are some constraints. When we record something, cost-benefit constraint. Only recorded when the benefits of disclosure, recording, are greater than the cost need be disclosed. Okay. And then materiality, only information that influences a decision of a reasonable person need to be disclosed. And then conservative and industry practices. These are specific to a particular industry or philosophy, and we'll kind of include those as well, though they're not as specific as cost, benefit, or materiality constraints. Number 10, here's our first exposure to the accounting equation in each of its pieces or components. Assets always equal liabilities plus equity. Okay, so assets, resource owned by the company, liability, something we owe, and equity, the owner's interest in that business. We can expand that equation, and it's shown down there at the bottom. Assets equal liabilities plus equity, which is the owner's capital, what he put into the business, minus owner withdrawals, what he takes out from time to time, plus his net income, which is revenue minus expense. We'll look at some business transactions. Here's one. Here's our owner. He puts $30,000 of his own cash into the business. How does that affect the accounting equation? Well, his asset went up. Cash is certainly a resource, and his equity, his investment in the company also went up. You can see we've increased both sides of that accounting equation by 30,000. And the point is that the equation remained in balance. Here we have number 2, he buys some supplies, he paid cash for them. Only affects one side of the accounting equation. His cash went down, but he's got something for the money that he spent. He's got $2,500 worth of supplies, so it's a wash. Here we're buying those supplies, restating that. You can see our accounting equation stays in balance. Purchases some equipment for cash. He's got to get underway here. He spends $26,000 cash for some equipment. Here again, it's a wash. The asset cash goes down, the asset equipment goes up, the accounting equation is still in balance. And this just restates that the accounting equation remained the same. 30,000 on the left, 30,000 on the right. We bought some supplies. This time we didn't pay cash, so we have another asset. This time it's worth $7,100. We didn't pay cash. We have a liability, an account payable. That's on the right-hand side of the accounting equation. Left-hand side goes up by $7,100. Right-hand side goes up as well. Number 20 just restates that transaction. 21. Here we're dealing with a client. We're a consultant, and so we provide some consulting services. This is a good customer. He gives us $4,200 right off the bat. What happens to our accounting equation? Well, we got the cash. On the left, our assets went up. On the right, our equity went up. Remember that income, which is revenue minus expense, increases equity. So an increase cash on the left, increase revenue on the right. Accounting equation still in balance. And this just restates it. We're paying some rent here, and we paid $700 of wage expense. Okay, so our cash goes down. For the rent, $1,000, and for wages, $700. On the right-hand side, we have expenses of $1,000 and $700. Accounting equation still in balance. Providing services and facilities for credit. Okay, so we're consulting with another customer. This individual doesn't pay us cash, but we have his word that he is going to pay it in the future. That's an account receivable. His promise to pay is an asset. Goes up by $1,600. Revenue on the right-hand side goes up by $1,600. And then we've got some more rental revenue both of these transactions are for credit. And we'll take a look at the accounting equation to see that it's still in balance. You can see those two transactions there. Now we've got 41,500 on the left, 41,500 on the right. Here we have the receipt of cash for that account receivable. Remember, we had that client who just promised to pay us. Now he's going to actually pay us, and our cash goes up and our asset account receivable goes down. But the point is, assets remain the same, the accounting equation is still in balance. And here's just a restatement of that. Accounts payable, we're going to pay off $900 for those supplies that we purchased back in transaction 4. Cash goes down, but so does the liability, accounts payable. Number 30 shows the transaction there. 31 slide. The owner says, I need some cash. I'm going to take it out of my business. And so his equity is going to go down. His cash, his business cash goes down, his personal cash goes up, but we don't care about that. We're just keeping track of the business. So cash goes down, so does his equity. There it is. Go back a little there for you. This shows all of the transactions. It's a summary of all those transactions. And the point of that slide is that throughout all of these events and transactions, our accounting equation stayed in balance. We're looking at some financial statements now, and here are the 4 that we're going to talk about. There's the income statement. It just tells us the difference between revenue and expense. Hopefully our revenue is greater than expense, and then we have some income. If our expenses were greater than our revenue, then we'd be in trouble. We'd have a loss. Next one down, statement of owner's equity keeps track of the owner's investment in the business. Third one down, balance sheet, sort of a restatement of the accounting equation. Tells us what our financial position is, tells us what our assets, liabilities, and equity are at a particular point in time. And then the statement of cash flows. This is a really important statement that we don't spend a whole lot of time on traditionally, but it identifies what we spent and what we received. Okay, the cash that went out and the cash that came back to us over a particular period of time, and we segregate or categorize by operating, investing, and financing. We'll talk more about that a little bit later. Oops, sorry. That came from... See, this just gives you a nice visual what those financial statements really look like. They have a particular format in general. There might be a few differences from company to company, but generally speaking, that's the structure of those 3 financial statements. The income statement starting right off there, always prepared first because it affects owner's equity and the balance sheet as well. Okay, so that's the interrelationship between those financial statements. There's your statement of cash flows. If you look at your book, Exhibit 110, slide is really hard to read, but you can see there just barely that you've got the three categories of cash inflows and outflows. Take a better look at that if you would please in your book. It shows up a whole lot better for you. And that concludes your first lecture, chapter 1